This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for tuning in and for the continued support. If you like what you hear on the Planet MicroCap podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the show and join the microcap investing community. Registration is open for the Planet MicroCap Showcase Toronto in partnership with MicroCap Club, happening October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll want to be there. Visit planetmicrocapshowcase.com to register. See you in Toronto. Now, my guest on the show today is Balkar Sivia. He's the founder of White Falcon Capital Management. In this episode, Balkar shares his unique path from engineering to investing and why he built White Falcon around an unconstrained, opportunistic philosophy, one that rejects traditional style boxes like growth or value. We dive into White Falcon's 3 engines: compounders, value today, and value tomorrow, and how for Balkar, this structure should result in part of the portfolio always working. Balkar walks through case studies explaining how he looks for quality businesses facing temporary challenges and how narrative shifts and multiple expansion drive returns over a 3-year horizon. We also discuss the lessons he learned in managing value traps, how he's thinking about AI as an investor, and the importance of evolving your process over time. At the heart of all of it is a focus on quality management, incentives, and high conviction positions in a concentrated 20-stock North American portfolio. And for full disclosure, we mention a few names on the podcast today, and I'm not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Balkar Sivia. Balkar, thank you for joining me today. How are you doing?
I'm doing good. How are you doing?
Oh, can't complain. We're recording this on what's today? Tuesday, September 16. We got our event coming up in 5 weeks. We're just all, peachy and rosy, and here we go. Actually, we're going to be in your neck of the woods. You're based in Toronto, right?
And I look forward to being there, yes.
Oh, very cool. Yeah, it'll be fun to meet you in person for sure. So listen, we connected on Twitter. You said I got stuff to say. I said, great. I got a microphone where we can share what you want to say. So, I went through your letters, and I you got a lot of great stuff there, talking about, your process, research, whatnot. So, for folks that don't follow you on social or know about White Falcon Capital Management, can you give us that quick background on where your passion for investing began and then what led to you founding White Falcon?
Sure. Well, I'm a non-traditional candidate into finance. I started off with a degree in engineering. I worked as an engineer for a few years, and I was just investing my paychecks on the side. After some time, I was having so much fun investing the paychecks, and I was young enough. I figured I'd kind of pursue this as a full-time job. So I started writing a blog. I started peppering some portfolio managers with investment ideas, and that led to my first job in the industry. And, this was in Vancouver with somebody named Tim McElvain. He used to work under Peter Cundall. So he was a deep value investor. So I had my kind of deep value roots there. And then I moved to Toronto to work for Burgundy Asset Management. This is a quality value firm. It's actually a pretty big Bay Street firm. They manage about $30 billion in assets, research first, client first firm. So I was there for 8 years and kind of learned from some very high quality people. And 2021, I'm at a point where I have about 15 years of experience, and there's no PM seat at Burgundy. So I start White Falcon. I also was thinking about investments a bit differently compared to a lot of people in the industry, and we can talk a bit more about that as we go forward in this call. But I founded White Falcon in November 2021, which was the peak of the market at that point in time. Talk about timing. But it's been a good 4 years since. We've we've grown. We started off with friends and family, but we have since added on family offices, and we have grown since then. Performance has been good. So, so that's where we are.
Very good. No, thank you for that, Ovi. That's great. So, it's funny. I was thinking, came into finance for the non-traditional back. I feel like everybody who I've interviewed on here has come into finance from some kind of non-traditional background, or so the non-traditional background is now the traditional background. I'm just going to claim it right now. That's it. If the non-traditional background is like, well, I went to, I got my undergrad in business, and then I went to get my MBA at Stanford. No, but anyway, so yeah. Thank you for that full background there. So you kind of led the witness here with the next question. But what would you say was that big differentiator for you, where you're like, all right, I wanted that PMC, but like I also have a differentiated viewpoint of how I want to run my own book, and that's why I want to start White Falcon. So what was that big differentiator?
Yeah, I mean, when you look at the industry itself, the industry is kind of divided into boxes, right? I mean, you look at there are people managing large cap growth funds. There are people managing small cap value funds. And that's how the allocators kind of divide the industry, and that's how the industry is organized, right? But if you kind of go back to Buffett and Munger and kind of the original sources of inspiration that we all have, they've never been in a box. They do whatever it takes to make money. That's kind of the bottom line, in terms of what they do. So, being at a value firm, there were a lot of companies that I saw and I recognized as good quality businesses, good managements, but they were just priced a bit too high. So we never bought them. But we saw them do much, much better over time because of the quality of the business, right? So, again, I started in the business in 2008, 2009, just after the GFC. And they say when you start in the business really kind of affects how you invest. So until 2014, 2015, I found nothing cheap. In hindsight, everything was cheap in 2011, 2012, 2013, right? So, and you kind of think about at that time, and all that was a mental block, right? And, and then I'm like, what other mental blocks do I have, right? And so that kind of led me to this unconstrained, opportunistic investing philosophy where, where I say I'm not in a box. I'm going to do what makes sense. I'm going to look at the quality of the business. I'm going to look at what I think it's worth in 3 years. And I'm not going to kind of label myself on a quality or on a growth or a value scale. This insight also came from Warren Buffett, right? I mean, if you think about what Buffett did when he ran BPL, his hedge fund, is he had 3 different return streams. He had workouts, he had controls, and he had generals, right? So one of them worked at a particular point in time, the other ones were not working. But the point was that he was getting some engine within his portfolio to run, even if one engine was stalled. And then, the engine that was stalled would run, and, so he would just keep chugging along, and all this would help his performance. And he could allocate capital from the engine that was running to engine that was not running. So similarly, what I do is I divide the portfolio into compounders, which are kind of my core holdings, which I think can, grow earnings over time. And then flank that with kind of value today, which is value companies or deep value companies, and value tomorrow, which are growth companies that have, something's going wrong with them, and therefore the valuations have come in.
Got it. Okay, sorry, I was just taking a couple notes there. So it's interesting that the differentiator here. So let me try and explain it for my own layman self. So I mean, it sounds like you're wanting to not really label yourself as like, oh, I'm another deep value strategy or another growth or GARPy strategy. At the end of the day, it's all, and also like not even just small cap or micro or large cap. You're more like, all right, I'm presented with an idea. Does this make sense according to my criteria? No matter where it lands in the spectrum of what the company could be. Okay, so that's interesting. That's a great place to start off. So in my head, and this is just for me speaking personally, if that were my mandate, I would probably drive myself crazy and be like, where do I even start? Like, what, how do I, what do I, okay, it just makes sense. Okay, there's tens of thousands of public companies I could choose from that, could possibly make sense for my strategy. So how do you reconcile your process with just finding things that make sense to you?
Yeah. So first of all, I'm limited to investing in North America, but even in North America, there are a lot of companies, right? So to your point, I think the only way of limiting yourself is limiting, your circle of competence limits you, right? I mean, there are only so many mental models that I have. There are only so many ideas that kind of fit into the criteria that I have for making investments. So those would be my filters. Again, I'm looking for good quality. I'm looking for undervaluation. And if you really are focused on these two things and really try to kind of apply yourself and say, I'm not going to compromise, there are actually not that many ideas that meet that criteria at any particular point in time, right? So that's kind of how it gets limited. I run a 20 stock portfolio, so I don't have kind of a lot of room in terms of having ideas that I don't have high conviction in. So for me to get conviction, to get comfort, to get the quality and to get the upside that I want, I think all of that is difficult to find.
100%. So, I could ask you about, what are your metrics that you screen for that meet your undervaluation stuff? You could go into them, I'm sure. But at the end of the day, like you said, good quality first for a reason, right? So how do you evaluate what potentially could be good quality for you?
Right. I mean, lots of things. I mean, all the traditional stuff that kind of everybody talks about, essentially kind of the moat that the business has, the return metrics that it has produced in the past, and now. But I think one of the most important criteria that I've come to realize, over time, that kind of determines. So the business quality is important, but the management quality is equally or more important. Kind of the culture that the company has is equally or more important, because at the end of the day, you go through an earnings call or you go through, a 10Q or 10K. The question that you have to ask yourself is, do I believe that this management can execute on this opportunity and get the company to A to B, where, B is when I make my money, right? So I spend quite a bit of time just kind of learning about the people behind the business and making sure these are the people that I want to bet on to realize the opportunity that they have, right? And again, just to kind of backtrack and kind of talk about quality, I think one of the things that I've seen, this is again very kind of different from analyst to analyst, in terms of what they consider to be quality. I mean, I know people that go back to the 2007 crisis and the 2001 bear market and kind of look at how the company performed during those years to determine how it'll do it, in the next downturn, as an example. So there are different layers of how people think about quality, and for me, it's the business, it's how defensible I think the moat is, and the management.
So when you're starting to evaluate the quality side of things, basically you're qualitative, at what point after because assuming you talk to a friend or through the screens, you can go through your process if you want for the discovery phase. At which point after you've kind of gone through some of the numbers and gone through everything like that, then you're like, all right, it's time to talk to management, ask them some questions, what's your process there?
So I mean, I tend to talk to a lot of managements. I think just talking, part of my process is I schedule calls with IR all the time. And even if I'm curious about a company, because it forces me to work on the business, and it usually gives me insights into kind of what is happening at a micro level in that company, in the economy. So I'm always doing calls, but from the perspective of a particular opportunity, it's usually I've been following that company. I've been following earnings for a little bit. I may have talked to the company in the past at some point in time. The stock has come in. The stock has come in for whatever reason, which I think is temporary. that's when I would go into my. I also have access to these expert networks. I would schedule some expert calls, talk to them, talk to them about the culture, talk to them about the quality of the business, and then once I have most questions answered, I talk to the company to just see how they think about the opportunity and the risks from here on.
Very cool. All right. So, love to hear a little bit more about your process, going through the whole from discovery to, starting to take a position. And if you would like to use an example to kind of demonstrate how, this works in action, love to hear the whole thing.
Sure. Okay. Let's, one of the companies that I own that is still a good opportunity, and I bought it about 6 months ago, is a company called Grifols, ticker GRFS. Grifols is a plasma derivative manufacturer. So essentially, they take plasma, people donate plasma or people give plasma, and they take this plasma and they manufacture products from it and kind of sell it to people that need these products to manage autoimmune diseases. And the way that this business works, I'll just quickly talk about the business. The way this business works is you have to have a lot of collection centers where you can collect, where people can come in and donate plasma, or where people can come in and sell plasma. And then you take this plasma and you take it to a central manufacturing facility where you store it, you test it, and then eventually you separate it into different products that you can then sell. Right? So that's the business. And so the reason that this is a good quality business is it's a 3-player market globally. It's a business that requires a lot of capital upfront to build these centers and to build these manufacturing facilities. It's a business which has root density benefits in the sense that if you are there first, then somebody else who's coming in second will never get their capacity utilizations to a level where they'll make any money. So if you're there and if you're expanded, you essentially have a de facto oligopoly in that region. And then it's a trust business, right? This is plasma, kind of people's blood. If there's something wrong, if you didn't test properly, if you didn't store it properly, if anything goes wrong and you get a bad reputation on your product, you're done as a business. So this is a company that has been in existence for a long, long time. But then in 2020, 2021, 22, it went through a bit of a perfect storm. So people in the US actually get paid for plasma. And because of stimulus checks after COVID, people weren't coming in. And they had to increase prices for what they had to pay for plasma, hitting their margins, right? So the business was a bit on the downturn a bit, and then a short report hit with issues with the family that controls Grifols. And some of those issues were real issues. Over time, the company solved a lot of these issues when it came to corporate governance. There were activists involved, activists got on the board. And at a certain point in time, Brookfield bid for the business, right? And that's what piqued my interest. And Brookfield is kind of a well-known Canadian asset manager. They're known to be kind of very smart capital allocators. So they're bidding for this business. Things must be okay from a corporate governance perspective. If Brookfield is bidding for the business, they must like the business. And if the activist investors on the board rejected that offer, then there's enough power, family member, board members, to do the right thing from a corporate governance perspective. So that's when I got intrigued. I read everything I could on the business. I read the short report, the earnings transcripts, of course. They had an investor day earlier this year. Kind of went through that. Talked to management twice, and then I made my buy. Right, this is the business that used to trade at 20 to 25 times earnings, 12 to 15 times EBITDA. That is now trading at about 10 times EBITDA, 12 times earnings, because the market still is in disbelief of what the business went through, both from a business perspective and corporate governance perspective, in the last 3 years. But what I'm seeing is everything has been cleaned up, and the business is on an upswing, right? So again, so I mean, this I think gives a good example of both the quality that I'm looking for, with the moat that the business has and the valuation and the management.
Well, it also is a decent example that I'd love for you to expound on a little further. This concept that we haven't really talked about on here is, I mean, we have in different ways in which people describe it, but the idea of value today, and as you express it on your website, it's we can opportunistically buy businesses that are cyclical or businesses that are facing temporary problems with the condition that we are able to buy these businesses at a deep discount to their intrinsic value. Now, everybody and their mother would be like, all right, how do you avoid the value traps? So I'm going to ask you straight up, how do you avoid the value traps?
Yeah, no, it's very difficult to avoid the value traps, and
so hard.
I have been, many times in my career, in a place where I have been confronted with value traps. I think it's difficult to confront them. I think it's difficult before to avoid them. I mean, there are ways, and people have talked about it on your podcast. But I think the way to deal with them, from my perspective, is to change your mind, even at a loss. Right? I think that's the best thing you can do. I mean, that's something that I'm trying to get better at as a value investor, is to just let go. I mean, not to have my ego involved in kind of whatever company or opportunity I'm in. Yes, you always have the fear that this is going to run as soon as I sell. Let it, right? But from your perspective, from your, one of the things that you realize over time is a very scarce resource that you have, right? And then mental strength and then kind of mental bandwidth is even scarce. So if you have an idea or two that are taking a disproportionate amount of your time and your research effort, I think you're better off pruning them from the portfolio than keeping them, right? So I very actively try to have, not a trader's mindset, but just say, if something is not working, instead of I'm not just going to fight it, I'm going to get rid of it. I'm going to clear my mind and come back to it or something else later.
So I'd love to hear an example of where, you thought, let's take your most egregious example that you might have, where you looked at it, it fit all the metrics, talked, man, like this is a slam dunk home run, shouldn't have to keep doing all the follow-ups, everything like that. But then you found yourself spending an inordinate amount of time because the thesis just, all right, okay, it didn't hit here, but maybe the next quarter will hit.
That's right.
Didn't hit again.
Yeah. And these are painful, right? These are painful to go through. But I own a company called Endava. So Endava is a company that does digital IT outsourcing. So essentially, any company that needs digital apps built, they go to a company like Endava and they kind of ask them to help them, either save money on their existing operations or make money by kind of becoming digital first. So again, software is eating the world, right? But any company that is not a software first company doesn't have the IT resources to actually build these products and compete with the software first companies. So they hire people like Endava, like Accenture. So this is a company that kind of competes with Accenture, but is a much smaller company than Accenture, right? So this is a company that did really well kind of coming out of COVID because everybody wanted to work from home. Everybody wanted to spend on IT to kind of get their systems up to date, and all of that. So the stock gets $150 a share, right? And then it comes down to about $60 a share. And I'm like, okay, this seems cheap because again, this is a business that can grow for a very, very long time because everybody needs more IT, more software, and all of that. And the reason that these companies win is because once you get into a client's IT department, it's very hard to get rid of you because then you just finish one project for the client, and then you suggest the client needs another 3 projects because if they want to be competitive with their peers. Right? It's a similar thing like when Warren Buffett bought IBM. and he kind of talked to all Berkshire companies, and he realized that every company has an outsourcing arrangement with IBM, and nobody's firing IBM, and in fact they're using more and more IBM every year. He was wrong in that thesis, but leaving that aside. So what happened here is that macro hit. So they over-earned during COVID, so they were under-earning. So the earnings started declining. And I bought at a point where I thought that earnings had declined enough. But then AI came, right? And with AI, there's a narrative that AI will make engineers more productive. Therefore, you will need less software engineers. Therefore, the businesses of the likes of Endava, will not be as valuable anymore, right? So while that may be true, my thesis was that AI will require even more software development, because all the companies that are not AI ready would have to become AI ready. And part of the reason they can do that is because companies like Endava will help them. But what happened in the interim was that the managements for the clients of Endava, they just froze, right? Because AI was coming in and AI was changing every 6 months. So they didn't know what their future technology roadmaps was going to look like. So they just stopped doing projects. They just stopped doing any projects, and Endava's revenue started declining. And this is again a company where the management said, "Hey, this year we're back-ended guidance. We're going to be much better fourth quarter than we are first quarter." Okay, fourth quarter comes in. Okay, we missed, but next year we're going to be much better fourth quarter than we are first quarter. So you go through that a few times, and then you're like, no, that's it. I'm again. This was something that it can still work, right? I mean, there's no reason it can't work from here, but it was just taking a disproportionate amount of time from my perspective, and so this is something that I just got rid of, and now I'm saying, okay, I have some cash in the portfolio. Can I find a better risk reward than I had with Endava?
Absolutely.
It's painful. It's a loss, but
yep.
It's part of the business.
Absolutely. Here's another value trap, experience I'd love to hear, where, maybe you looked at a company and you did all the digging and everything. You're like, this has value trap vibes. I'm feeling it. Like there's something about this that I think I like the risk reward spectrum that's way riskier than, maybe, but you know what? I'm going to take a shot here and maybe, and maybe it ultimately worked out. I don't know. Did you ever have an experience like that?
No, I've lost so much money on kind of terminal risk companies that I try not to go into that segment.
Yeah, that makes sense. You got to be disciplined. At the end of the day, if it walks like a duck, talks like a duck.
Because what I'm ideally trying to get is I'm trying to get a multiple expansion in 3 years when I sell the stock.
Right.
And the only way I get a multiple expansion is if people are very excited about that stock at that particular point in time. So I try to imagine scenarios where the business that I'm trying to look at, what would make people really enamored with this in 3 years. Because I'm looking to get multiple expansion and earning expansion to kind of make my IRR on the idea.
That's also interesting as well, as trying to build out what does the future narrative really look like, right? Because it's tough. That's actually a really interesting point, because I don't think sometimes it's all right, all they got to do is execute. It's well, there's also, if you just think about it a little bit further, it's well, it also helps for your thesis, where it's not just saying, all right, I have multiple here, and that works for some. I'm not saying it doesn't, where you're very disciplined. You're okay, I assign this metric or this valuation metric. This is where it should be in 2 to 3 years. But what's also very helpful, especially if you're looking at maybe even some of these growthier names, or, they had a bad core, but there's still a lot of value there. It's also building out that narrative of okay, well, what, I think I see something that would get me excited about this, now. What about this name right now could get people excited about this in 2 to 3 years? What does that story look like? How can I imagine that the press release or that earnings report? So yeah,
and that's exactly it. I mean, that's what I do. So I'm trying to buy things that are okay now and that are going to become great tomorrow. and then trying to buy things that are really bad that are going to become okay in 3 years, right? So I mean, I'll kind of talk about that as an example, with an example. So I own this company called Rentokil, right? Rentokil is a pest control company that competes with Rollins in the US. Now Rollins has a PE of like 50, right? Rentokil has a PE of, what was the last PE? I think maybe 15, 16 today. So that's a huge difference in multiples for a company that is in the same industry as its closest peer, right? So this is a company that acquired a company called Terminix in the US, and it merged its own operations with Terminix, and the integration has not gone well. So this is the case where we know that pest management is a good quality business. Again, it's a root density based moat where, if I have a branch in a particular neighborhood, and if I can service a lot of households in that neighborhood, then I would have the lowest cost compared to somebody that's serving a household here and then another in a different suburb and another in a different suburb, right? So if I can get as many clients as I can in a particular area, I become the de facto lowest cost provider for that area, right? So again, a root density based benefits, brand, an essential service. Kind of a lot of businesses have to have pest services, so it's kind of a SaaS type recurring revenue business from that perspective. All commercial buildings, etc. For many households, it's a essential service or an emergency service, so pricing can be very, very good. So anyway, so it's Rollins trade that 50 times earnings. So we know that this is a business that, with the right margins, with the right P&L, can have a very high multiple, right? So why does Rentokil have a very low multiple? It has a low multiple because it just did a merger that is not going well. Okay, what's happening then? Nelson Platt's fund just took a big position in the company and went on the board. The CEO that oversaw this merger is leaving. They have new management coming in that is very US centric. So they're trying to fix a lot of these issues that exist today with this integration. And in 3 years, can I see the P&L of Rentokil be very similar to the P&L of Rollins? I own the stock, so I can, right? And then when that happens, what multiple will it get? I'm sure it'll be higher than the 16, 17 times multiple. Because then the narrative changes from this is a turnaround to this is a compounder, right? That's what I'm going for.
Very cool. All right. Well, we've covered a lot. Hey, real quick, just to cover from your letters. I mean, we could talk tariffs, all that. I think most of that stuff is kind of out there. But you mentioned also with the one where you ended up cutting your losses is that you saw one of the forward-looking themes obviously is expectations around AI technology. So how have you been wrapping your head around and thinking about what kind of thesis have you been putting together when you're like, okay, AI clearly here to stay, a lot of momentum here, a lot of frothiness as well. So how are you been thinking about and putting together a thesis when you're looking at potential AI companies and how to play that?
Yeah. So so that's interesting. I mean, it's a big change, right? It's a big change and it is affecting everything and everybody. And this is something that I struggle to keep on top of because it's changing so quickly all the time. But I try my best to do that, but it's very difficult to kind of be on top of it, right? And it makes me extra cautious of investing. So, for example, there are many software companies today that are cheap or getting cheaper because of an AI risk, right? I mean, there's a narrative today that, hey, these software companies that exist today, they may not exist in the same form tomorrow because agents will do a lot of the work that the software companies do. Now, I haven't formed a conclusion on if this is true or not, but 2 years ago, I would have kind of gone into software companies and said, hey, which one do I want to buy? Because the narrative at some point is going to change from AI is going to affect software to AI, the AI is going to help software. But I haven't done that because I want to learn more before I do that, right? But what I've done from an AI perspective is, again, I own AMD. So this is kind of a lot of people kind of are a bit surprised at that. But if you look at the AMD chart, right? I mean, this is how these kind of pod shops and quant funds and passive investing and kind of narrative-driven investing can help an opportunistic investor such as myself. Is you look at the chart, and in 2022, 23, stocks at 60, 65. Then it goes to 230. Then it comes down to 90 earlier this year. Then it goes to 180. Right? In all this time, I've bought when the stock was at mid-teens earnings. Right? I've stuck to my valuation discipline and said I'm going to buy it when it's cheap, and that's what I've done. And it benefits from AI. Great. I love the optionality, but I think that's what I think. Again, this is a large cap company. It's not a small cap company. But look at the volatility, right? But if you understand the business, you understand. Again, Lisa Su, I think, is one of the most formidable CEOs out there, right? So if you understand the company, if you understand where AMD came from, what she did for the company over the last 10 years, and if you believe that she will kind of shepherd this well going forward, also in the AI era, and you're getting it at 15 times earnings, you buy it. And then when the market's very excited, you trim some. So that's what I've done from an AI perspective, right? I'm just try to go into AI adjacent when it makes sense from my quality value criteria.
Very good.
Yeah.
So, question on here that I love to ask everybody, and you've given so many examples, and that's been great. But what would you say has been throughout your entire career, even prior to White Falcon? What would you say was a learning investing experience that you've learned the most from, and or guided your current outlook and thesis or philosophy when you're looking at potential investments?
Right. I think in the beginning, it was again, Warren and Charlie, right, which are formidable and which kind of are the base of your investment philosophy. But I think over time, I've learned from a lot of other people, investors, books. I think as you kind of spend some years in the industry, and as you kind of go through some live case studies, you have your capital or reputation at risk with ideas. I think all of that teaches you, right? I mean, there's a lot of feedback loop in this industry, and if you're not learning, then you're not growing, right? So again, the first kind of transformational thing for me was to, again, kind of get out from my 2007, 2008 mindset of I have to buy everything for 10 times earnings or less, right? It was to appreciate quality. That if a company has good quality, you should be paying more for it because it is a good quality. And, waterfront property goes for more than a house, in the suburbs, as an example, because there's usually more optionality with a good quality company, because the people that work for these companies are incentivized to perform and do better than the average company. So that was number one. And then number two was, again, being a value investor, you look at all these technology companies and you say, oh, these are profitless tech companies. Oh, I don't want to look at this. This is a bubble, or that is a bubble, right? I think the lesson that value investors learned after the 2001 bubble was a wrong lesson. I think if you go back to 2001, 2002, a lot of internet stocks crashed. A lot of value stocks took off, right? So value investors had a really good 2002 to 2008. Growth investors did not do that well. And the lesson that the value investors took from that is, growth doesn't work. Value is the only thing that works. And then since the GFC, value hasn't really worked. Growth has worked, right? I think what the lesson from the GFC, lesson from the internet bubble should have been, can I buy some of these really growing companies at really cheap prices, right? I should be looking at unit economics, not the overall P&L of the company. right? So in 2022, as an example, I bought a lot of these SaaS companies that were not making money at that point in time. And I got some pushback in saying these are not value companies. But then, but that is something that I had kind of evolved into and learned from. I mean, you saw Uber, you saw all these companies kind of go from kind of really loss making to very, very profitable. You saw Adobe on the software side kind of do the same. So you had all these kind of examples. You had all these mental models, and if you were right if you did your analysis on the unit economics, then you knew that this company will eventually show these unit economics in the P&L, and then you would make money. So this is again just from an evolution perspective. I've learned to evolve and kind of just see things for what they are, not for what dogma tells you to believe. Yeah.
Great. All right. Well, listen, you've answered all my questions. We've really covered quite a bit here today. So, I mean, look, to close this out, final thoughts, maybe some recommendations, or, maybe you have some advice for folks that are kind of just getting their toe wet and getting started on their investing journeys.
Yeah, I don't have a whole lot, except I'll just say that, I mean, there are very few or no shortcuts in this business. You have to put in the work, and the more work you put into this business, the more you get out of it. Because, I mean, this is a learning profession at the end of the day. So you just have to learn, right? And there's no shortcuts to that. And the best way to learn is, again, go back to the source materials. Not to a presentation, not to a sell-side report. Go to the source materials and actually see what is happening with the business and see what is happening with the P&L. Focus on incentives. I think incentives drive everything. So, to the extent that you kind of focus on how the management is compensated, what they believe in, that's very important. And just learn from your mistakes, be nimble, evolve, and make money.
Love it. Well, Balkar, that's a great place to end it. Where can our audience go and find more information about you, White Falcon, as well as following on social?
Yeah, so my website has all my letters. I write a letter every quarter. I usually have an investment idea in the appendix of this letter. So this is on my website, whitefalconcap.com. Feel free to sign up to get the letters, to get the blog posts. I'm also on LinkedIn. I'm also on Twitter. Not very active, but I am on Twitter, White Falcon Cap. But I'd love to kind of get in touch if somebody wants to talk about stocks or any of the stocks that I mentioned, or if anybody has an idea that you think will fit my criteria, would love to talk.
Awesome. Well, Balkar, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe, and I'll see you in a few weeks here.
Okay. See you then.
Thank you.
Take care. Bye-bye.